Hi guys, it's Stock Curry, and we have officially started the Millionaire Club Challenge. In today's video, I'm going to go over the 5 best value stocks to buy now. These are the 5 value stocks that we bought in the Millionaire Club Challenge on Friday in order to get this party started. Now, before we get to what those 5 stocks are, I want to give you a quick recap about what the Millionaire Challenge is and why you are going to want to participate. The Millionaire Club Challenge is an event where we're starting with $2,000. We are going to be depositing $200 every other week or $100 per week, whatever's easier for you. In total, it's going to be $5,200 per year that will be deposited into the account. And based upon the strategy that Warren Buffett, John Templeton, and many other billionaires used to invest into the stock market and make their first $1 million, we are going to be using the exact same strategies. And using their strategies, we should all become millionaires within the next 10 to 15 years, using the strategy starting with $2,000 and depositing $200 every other week. Now, the big benefit of doing the $5,200 per year or $100 a week or $200 every other week is that it's below the threshold limits for a Roth IRA. So if you want to do this in a Roth IRA and do the entire event tax-free, you can absolutely do that. Otherwise, we have other brokers that you can use. And for these brokers, you can get up to 25 free stocks that can immediately boost your portfolio by 5 to 10% getting started, which is a huge kickstart when we need to generate about 35 to 50% annualized returns in order to hit $1 million in the next 10 to 15 years. And believe it or not, it is possible. In some prior videos leading up to this kickoff challenge, I actually went over how Warren Buffett did exactly that. How it generated a 35 to 50% annual return for the first 15 years in his portfolio. So that's a recap of the challenge. If you want to join us in this, if you have not opened an account and gotten started yet, at the end of this video, I'm going to go over a few brokers where you can get those up to 25 free stocks. And for now, let's get into the 5 stocks that we bought in order to get this challenge started. All right, here's an overview of the portfolio. As you can see, we started with $2,000. We got about $60 in free stocks so far. We have another 5 free stocks that are going to be coming to us at the end of this month. And so total, the portfolio started with around $2,060. Now, the 5 stocks that we bought on Friday are IPI, Vale, ECPG, FINV, and ZIM. Now, before I go into detail about why I chose these 5 stocks, I want to make it very clear that I am not a financial advisor. This is not a recommendation to buy, sell, or hold any asset. These are just my opinions, the stocks that I felt were the 5 best value stocks to buy now. I encourage you to go do your own research and to buy your own stocks for the Millionaire Challenge portfolio. Now let's get into some details on the 5 stocks that I bought, and the first one is IPI, Intrepid Potash. IPI is currently trading at a PE of 2.05. The sector average PE is 9.59. As you can see here, IPI has had 4 quarters in a row of not only positive earnings, meaning they've been profitable, but all 4 quarters have shown an increase year over year. So very strong revenue and earnings growth on IPI. On the balance sheet, IPI has $209 million in current assets and only $63 million in current liabilities. So it has a very strong balance sheet. Overall, IPI is a very strong company. They have a great balance sheet. They have continual earnings. They are growing revenue and earnings. Overall, a great company. Now, the reason IPI has such a low PE ratio right now generally has to do with the fact that they are in the fertilizer business, and a lot of people think fertilizer costs are going to come down, which is going to lower their profits and revenue. That could be the case. It might not be, but at this current PE ratio, I think it's a good stock to buy. The next stock I bought was VALE. This is Vale. This is a mining company based out of Brazil. Vale has a current PE ratio of 2.98 versus a sector average of 4.57. They are profitable every quarter for the past 4 quarters, but you will notice that their earnings actually went down year over year in the last 2 quarters. The reason for that is because being a mining company, the cost of raw materials has gone down after it spiked in the wake of the COVID shutdowns. And that means their earnings are starting to drop a little bit. So their earnings per share is very low out of fears of future earnings going down because material costs might continue to go down. However, I do believe that with inflation skyrocketing around the world, we could see that start to increase once again. Either way, that is why Vale has a low PE ratio. And again, it's another one that I'm willing to take a little bit of risk on. Taking a look at their balance sheet, they have total current assets of $16 billion, and they have current liabilities of only $12 billion. So more assets than liabilities. That's a very strong balance sheet. Now, as you might have noticed, these first 2 stocks carry some risk. And the reality is all of the stocks that we are buying in this challenge, they all carry risk. No stock is going to have a low PE ratio below 5 without having some sort of significant risk behind it. So I'm going to do my best to try to explain the risk behind each of these stocks that we bought. And just understand, this is not a low risk challenge. To turn $2,000 into $1 million in 10 or 15 years requires taking on some risk. That said, history has shown time and time again with people who have made billions in the stock market that investing in these low-risk value stocks is the best way to generate consistent returns. The next stock I bought was ECPG. This is Encore Capital Group, and they are a debt collection company. This stock is interesting because, as you can see here on the chart, they just hit a new 52-week high despite the fact that we are in a bear market and a recession. They have a current PE ratio of 4.09 versus a sector average of 4.67. They've had 4 quarters in a row of consistent earnings and profitability. However, you will notice that in the last quarter, their earnings per share dropped. And they are expected to have another drop in earnings per share year over year next quarter as well. Now, this balance sheet is not as strong as some of the others, but I still feel like it's a fairly safe balance sheet. And the reason for that is their total current assets are $195 million, but their total current liabilities are $1.17 billion. So they have almost 5 times as much current liabilities as they have current assets. Now, the one thing that you have to look at, being that this is a finance company, are their investments and advancements on their non-current assets. In other words, ECPG has access to $3 billion in capital if they need it. So that should help them easily pay off their current liabilities. I would also like to point out that their total assets are $4.46 billion and their total liabilities are $3.23 billion. So they do have over $1 billion more assets than liabilities. Now, being that ECPG is a debt collection agency, obviously, if you've ever had bad experience with debt collectors, you might not want to invest in this company if your morals don't allow you to go there. That said, during a recession, ECPG is going to see a little bit of a downturn in their profits. And that's because their business model is they go to a company and they buy these bad debts, these debts that people aren't paying on for dirt cheap, pennies on the dollar. And then they use their methods, all of their telephone people, their email people, all that, to go out and then collect debt. And even if they're only able to collect 10 or 15 or 20% of the total amount of debt that's owed, they can still turn a profit off of that because they bought the debt at such a very, very low valuation. Now, during a recession, as people are getting laid off from their jobs, the amount of bad debt is going to balloon, and ECPG is going to have a very difficult time collecting debt from people. But once things turn around and the recession ends and people start getting jobs again and employment wages go up and all this stuff, there will be more people who are able to pay off their debt, even their old bad debt, and that's when ECPG's profitability should skyrocket. So this is one of those companies that's going to have a little bit of trouble for the next year or two, but then later on down the road, 3, 4, 5 years from now, their profitability should skyrocket. So we're definitely going to have to be patient with ECPG. Now, the next stock I bought is FINV. This is FinVolution, and this is by far the riskiest of all of the stocks that I bought. FINV has a current PE ratio of 3.4 versus a sector average of 18.72. Now that is a significant difference on PE ratios, and I'm going to explain the huge risk behind FINV and why their PE ratio is so much lower than the sector average. Taking a look at the income statement, you can see how they've had 4 quarters in a row of consistent profitability. But take a look at the currency unit, and you're going to notice this currency unit is in Chinese yuan. I'll explain why that's risky in a minute, but first let's take a look at the balance sheet. They have $17 billion in current assets and only $5 billion in current liabilities, so a very strong balance sheet. Now, the reason FINV is so risky is because of something called the Holding Foreign Companies Accountability Act. And among other things, this statute requires the Commission to identify public companies that have retained a registered public accounting firm to issue an audit report where the firm or branch both has an office that is located in a foreign jurisdiction, that is anywhere outside of the United States, and the Public Company Accounting Oversight Board has determined that it is unable to inspect or investigate the audit because of a position taken by an authority in a foreign jurisdiction. Now, because China is not allowing the United States to take a look at the accounting of the companies in China, they're claiming it has issues to do with privacy laws in China. All Chinese companies have been put onto this list for possible delistment from the US stock exchanges. It includes companies like Alibaba, Yum, Futu, Baidu, Sohu, Lunkin Coffee, Li Auto, Tencent Music Entertainment, TME, Xpeng, JD.com, Neo, and FinVolution. Now, despite the risk of delisting, I do want to be clear that nothing is going to happen this year or even next year, since a company would only be delisted after 3 consecutive years of non-compliance with audit inspections. So China has until 2024 to allow the US to inspect the audits of Chinese companies. Now, the other thing is, if you take a look at the account portfolio that I'm showing you here on Moomoo, Moomoo allows you to buy US stocks, but it also allows you to buy stocks in Hong Kong and China. So if FinVolution is delisted and we want to continue holding on to this, what we will be able to do is we'll be able to sell the FINV shares in the US, and we will be able to buy them on either the Hong Kong or China exchange. So because we have an account with Moomoo, the risk of delisting is significantly lower for us. That's also true for all other Chinese stocks such as Neo and Baidu and Alibaba. If you want to buy any of those stocks either in Hong Kong or China, you can do that with Moomoo. All right, finally, let's get to my favorite and least risky stock on this list. It is ZIM. That is ZIM Integrated Shipping. This is a shipping company that has cargo ships all over the world that allow goods and services to move throughout the world. Very similar to a company like CTRM. Now, I did consider CTRM for this portfolio also, but ZIM came out as the clear leader for a reason that I'm going to show you in a minute. First, let's take a look at their PE ratio. Their current PE ratio is 0.95 versus a sector average of 1.82. As you can see on the diluted earnings per share, for the last 2 quarters in a row, they have been profitable with massive increases in year-over-year profitability. But here's where ZIM really shines. Because they are now profitable, they have started doing a dividend. Their dividend last quarter was $2.50, and their dividend this quarter is a massive $4.75. At a share price of $49.12, that gives ZIM a dividend yield of 45%. I have never found a stock with a dividend yield of 45%. This stock is a slam dunk. And taking a look at their balance sheet to ensure this can continue, their total current assets are $5 billion, and their total current liabilities are only $2.76 billion. So they have over $2 billion in cash on hand that is not set aside for current liabilities. So as you can see, ZIM is the clear winner of these 5 stocks. I hold ZIM not only in this Millionaire Challenge portfolio, I also hold ZIM in a lot of other portfolios that I have as well. So those are the 5 best value stocks to buy now. Now, if you don't currently have an account to buy these stocks in, I want to let you know how you can get up to 25 free stocks. The first way is by opening an account with Moomoo. For the next few days, you only have a few days left, Moomoo is offering up to 13 free stocks if you open an account using my link in the description below. Now, if you deposit at least $100 or more, you're going to get 9 free stocks. And if you deposit $2,000 or more, you're going to get 13 free stocks. That can, right there, give you an automatic 5 to 10% boost in your portfolio, which is a huge kickstart towards that 35 to 50% annualized return that we need to generate. Now that's 13 free stocks. What about the other 12 in order to get up to 25? Well, if you open an account with Webull and deposit at least $100, you're also going to get up to 12 free stocks with Webull. Now, Webull works a little different, more of a lottery system. You'll get anywhere from 6 stocks at a minimum to 12 stocks at a maximum. So between 6 and 12 stocks with Webull, again, you have to use my link in the description below in order to get up to 12 free stocks with Webull. And so combined, if you open an account with Moomoo and Webull, you'll get up to 25 free stocks. A huge boost to your portfolio, getting started on the track to millionaire status so that you too can join the Millionaire Club. Now, I want to let you know that Webull is only available in the United States. Moomoo is available in the US, Singapore, and Australia. If you're in Australia, you can sign up for Moomoo using stockcurry.vip/MoomooAU. That's stockcurry.vip/MoomooAU. Your promotion's going to be a little bit different. If you are in Singapore, you can also sign up for Moomoo. Again, your promotion will be a little bit different. The link for that is going to be stockcurry.vip/MoomooSG. That's stockcurry.vip/MoomooSG. And if you're in the United States, you're just going to use stockcurry.vip/Moomoo. Now, I also want to let you know that if you're not in one of those 3 countries, let's say you're in Canada or the UK or anywhere else in the world, then I recommend Interactive Brokers. Interactive Brokers has by far the lowest trading fees of any broker out there. In Canada, it's just $1. In Europe, it's just 4 euros. It is such a low trading fee. So if you want to join the Millionaire Club Challenge and save yourself a lot of money on fees, I highly recommend Interactive Brokers. You can sign up for that. I've got a link for that on my platforms page at stockcurry.vip/platforms. That's stockcurry.vip/platforms. All right, guys, I hope you enjoyed the video and got a lot out of it. Don't forget to hit the like button and subscribe. And if you're on YouTube, click the bell icon and click all so that you can stay updated on the Millionaire Club Challenge. I hope you have a lot of success trading, and I will see you tomorrow.